What I'm about to tell you is a very risky way to trade. What's up, YouTube? In today's video, we're going to talk about Robinhood options again and how you can day trade them, right? Day trade them under the PDT rule. The PDT rule has never been something I've actually cared about. And I mean ever. That has never influenced any single one of my trades. In fact, most of you guys have that number so far just drilled into your head. You can't wait to get to it, and then once you finally do, your way of trading actually changes. To kind of show that off to everybody, not intentionally, you're going to see somewhere in here, before or after this, there's some B-roll footage of a new Corvette I bought, right? And I bought that with my Robinhood card. 100% took my Robinhood card there. Well, you'll notice that at a Ford dealership, right? Corvette happened to be there. I drive a Ford truck, and had to buy it. To be honest, it wasn't to show off. I don't mean to say show off. One of the trolls showed up saying I bought that for the ladies. I have 4 ladies in my house. One of them is 6. She loves it just as much as I do. But I'm literally showing everyone in my mentor group exactly this. Before we get into this video, heart to heart with you guys, focus on the trade. Whatever trade it is, make sure it's a good one. And that's it. Making money is a byproduct of a good trade. That's it. All you need to do is this trade worth it? Is it a good one? Again, does it have a plan? Is it structured? Are you just running and gunning, shooting from the hip? Or is it an actual trade? There's a difference in gambling and trading, and that is it right there. Having a plan or planning to fail. If you go out looking for a number you want to hit, how much money you want to make, and then you want to try to find the trade that makes that fit, you'll find the wrong one. But go out and find the right trade. Making money is just, again, the byproduct of it. That's just what happens when you trade, and you trade profitably. That's it. Focus on the trade. The money comes with it. And to show everyone this, a couple of screenshots. This is me just jacking around mentor group. We're about to go live. So I was showing this there, and first of all, I can't day trade for the next 90 days at my Robinhood account. Now I have my main account for trading shares, and then I have my Robinhood account, which I pulled the money out for the vet being above PDT, and now not. I can't day trade, and yeah, my new baby can't trade account. It even says right here, I can't day trade for 90 days because you're marked as a pattern day trader. Ha! Now, despite my Tesla video that came out as I'm recording it this morning, that was the Tesla position that I had a contract overnight. Gapped up, it was all right. And like I said in the video, I kind of expected the gap and crap, so I sold it. I did get back in. So I'm going through this with everybody, right? How many of you guys have an account that big? Not a little bit smaller? Guys, I've had trades that make more than that in a few minutes. But we're starting to go up here. Amazon. I just got into that this morning. 8:38. Market for me opens at 8:30. Thought Amazon was bullish. I recognized a bullish trade. Paid $60 for this contract. Now I can't day trade. So what can I do? Buying naked calls and puts. The most risky thing you can do. There are old traders and there are bold traders. There are no old and bold traders. Now, while I'm doing this very successfully, until I rewrite that book myself, I have to agree with the data and what history supports. No one that's been doing this for decades has done it just off trading naked calls and puts. Now, given them in the past versus now with the way technology is and how popular they are and how more liquid they are, things are changing. So we can't really live in the past, or we'll just repeat it. It's time to move forward. But what I'm about to tell you is a very risky way to trade. Now, it's risky. You still have to be right to begin with. If you are one that bag holds, This is not for you. You need to fix your emotions. You need to check your trading before you even consider this idea. So we'll jump back. You know what? Let me just pull up that position. I will show you guys. We got Amazon pulled up right here. Let's get it to, where was that one? 32.70 was the call. Okay, like I just showed you guys in that screenshot, I paid $60 for this times 100, $6,000 for this contract. That was a naked contract. If I'm wrong, that goes to zero. $6,000 out the door. So what can you do? It's certainly a riskier trade overnight. You hope you're right. I am right. But on your level of trading, are you there yet? You know, what's going on here? Now ignore this profit number right here, because what we just did was we turned it into a spread. Now focus on this. My average cost, paid $60 for that. $6,000. Okay, now that's, let this load. Now here's what I did. I sold this call again. Now buying a call is a bullish position. Selling a call is a bearish position. Doing that at the same time is called a vertical spread. Right? You want to buy and sell a call against it. This is a $10 spread. The max I can make is $10, so $1,000 for the spread. Here's the trick. Because I didn't buy it as a spread, and I'll show you, I'll pull up an options chain and actually show you, because Robinhood, again, doesn't show you much. Don't use Robinhood for anything it gives you other than the ability to access the markets. That's the key. That's the takeaway. Take it. It's awesome. Zero commissions. That's what it's got. I wish I could tell you more for that. But I got to be honest. It's Robinhood. It's pretty basic. I can agree with you guys on that. Now I sold that call for $6,400. Almost $6,500. $6,470. You can see it's down. Now it's canceling because as Amazon pushes up, this is selling off. Like this is pushing up, but I sold it. So I'm covering this person's tab. Whoever I sold this to, they just made $3,400. But this is a spread. Pay attention to those numbers I just told you. I paid $6,000 for a contract. I sold one against it. One that was cheaper at the time. I sold it for $6,470. I collected $470 for a spread that has a max gain of $1,000. So let's jump up here on TOS. Let's build one real quick. Option 20, what was that? 32.70, 32.80. This is in the money. Let's do an in-out spread. We're going to buy this one. We're going to sell this one. Right, so we're positive 10. We sold it. We have a bullish position. We have a bearish position. Now to buy this $10 spread, $3.55. That's a $10 spread. Realistically, once the market opens, once that spread closes up in the morning, you'll see that's actually going to be about $5. In-out spreads are usually right about the 50% mark. That's what we would want to pay more than that anyway. Buy the one in the money, sell the one out of the money. That's where it gets its name. A vertical spread is just that you buy the calls or you buy the puts. You buy one, sell it against it. Buy one, sell it against it. That's in the money spread. Out of the money spread, this is just an in-out spread. Oh, hang on, sorry. Let's just get back to that. Bought this one, sold that one. That is the spread. To buy that right now, you're paying $355. Even if that was it, you're paying $355. Where I actually did it one at a time, I bought the call, bought this one, right? So you paid $8,500 for it. Now, as it pushes up and goes in the money, let's say Amazon jumps up $10. This one right here, pay attention to where we're at. This call is now worth $9,000. And this one down here is worth $8,500. So once we make that move up, I sell this one against it. Now I have a free trade. I bought this one for $8,500. I sold this one against it for $8,500. That is still a $10 spread for a max gain that I could sell for $1,000 the next day. And I paid $0 for it. Or it goes up a little bit further. You buy it for $8,500. You know, we kind of work our way up, and then you sell that one against it. Now what I'm doing is I'm actually just jumping along the trend here, right? You can follow this as it pushes up. You know, it starts to sell off. If you catch a move like this, it moves up. We start to tucker our way out. This right here kills an options contract. You know what it does though? if you were able to catch it just right now, it's easy to show just the picture perfect plays, and that's what I'm going to show you right now. We'll delve into a little bit more of how risky things can get next week. So next week, maybe I'll make this a series part. I'm going to show you guys just the what it could look like. Next week, I'll show you every way it could probably go wrong. So don't jump into this yet. Again, you have all the time in the world to blow your account. Let's focus on the education and get your experience right. But borrow some pages out of my book, borrow some of my experience before you jump into this stuff. This right here kills a contract. If you have calls and it goes sideways, that's decaying away. That's that theta jumping in at you. But if you picture perfect, you buy this, you buy one here, it pushes up. You paid $8,500 for that one. Now it pushed up, it's $11,000, and you sold one against it for we'll say $10,500, right? You just collected $2,000. And you sold the cheaper one for $10,500. So that is how you collected that $2,000. Now it goes sideways. What happens? Theta kicks in. Now you sold that call, so you were positive theta. The call you bought is negative theta. Now you're theta neutral, which means as this goes sideways, so does your position. Right now, a naked call will just decay. You'll watch that just trend right on down. Look at those calls right here. It pushed up, it pushed up, pushed up, and it just trended right on down. Started to push back up. Right about here, you're probably about to break where it was over here. Again, we bought the call, pushed up, we sold one against it. We collected that money. And whether it was a free trade or not, we didn't pay the full price for that spread. If we're bullish, it's calls. If we're bearish, it's puts. That's that. That's locked in. That's going to have its fluctuations as a spread. As it pushes up, that spread will go up and will go down, but it won't be as drastic as it would be with a naked contract. Tomorrow, I'm not going to try to close those one at a time. I'm going to close it as a spread. We're going to jump into the options chain. We're going to click select like I showed you on last week's video. There should be a link in somewhere around here for it. Maybe a little card up top. Jump into the options contract. Go to Amazon, click select. You're going to buy the one that you sold and sell the one that you bought, the opposite of what it says on there. And you're going to close that spread. As soon as you click review, it's going to show you how much that spread is worth. Now, you already collected $2,000 yesterday. What is it worth today? Well, if that pushes up, that spread's going to max out at $1,000. You're going to sell it and make another $1,000 tomorrow. What's going to happen if it sells off? The spread might be worth zero. Now I have to drastically sell off and go to expiration. The spread is going to be worth something until expiration. So you'll sell it almost like what you do for salvage value on a contract, if you understand calendar spreads and how that works. But what you have here, you bought a call, you sold a call against it in a nutshell, right? That trade's done. Now what you have here the next day is a vertical call spread that you're going to sell. So you have the value from here and then the value from here. If you're right, you will gain money very substantially, very quickly, and you'll never have to worry about PDT ever. Even if you're above the PDT rule, you know what you did? You bought an options contract, you caught some awesome gains, sold one against it, and you still have the potential for it to continue. What you did, you locked in the crazy, and you put it into a normal, a safer, risk-managed position, where now you have a max win and a max loss of that spread. But if you collected money for that spread, your options are I made this much or I made this much more. That's an easy win for the books. Like that is a confidence booster. With or without PDT, you can do that all day long. Back to that same contract, paid $8,500. It pushed up. You sold one for $8,500. What does your account now have? You have $8,500 in your account. There will be probably some capital for that you'll need to have reserved away. So, but your available cash to spend, you now have. We'll take $500 off the top. We'll take $1,000. You have $7,500. Maybe you see another bullish play. Now you can buy a $7,500 contract and do it again. You can take multiple trades inside here. Let's say here you go, same day. You bought it for $8,500. It shoots up. Now you sold the cheaper call against it for $9,500. You collected $1,000. It pulls back, and you can afford to buy that same one. Now it pushes up again. Now you have two calls in. You average up here, pushes up again. You sell that same one against it. You can do multiple. The options are endless. What you have here is a trade that you locked in, sub PDT, and the next day a vertical spread. So next week we can talk about how many ways it's gonna go wrong. But that's kind of I don't want to say hack. It is a very dangerous way, a very profitable way. Again, in the stock market, Easy come, easy go. Very easy to make money. It's harder to keep the money. Again, I appreciate the thumbs up. I appreciate the subscribe. Let me know in the comments down below where you want these informational videos to go. Right now, Robinhood has a huge following. I want to get out to those as many people as I can. So I'm definitely looking forward to more lessons I can help you guys out. Let me know in the comments down below, and I will see you in the next video.